Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we have had a fair amount of volatility since we have met last week here on Tuesday with regards to Alphabet and Tesla's earnings last week, causing a bit of a stir in terms of growth stocks, specifically AI related stocks. However, we have seen that sell-off in those specific stocks largely contained to those specific individual sectors that have been leading the markets higher from a high valuation growth perspective. And the question for a lot of investors, which is very reasonable to ask, is whether or not that volatility from last week will continue to spill into this week or not. So let's take a look at the overall charts and see what the markets are currently telling us. So when we look at the S&P 500, we have seen a pretty significant pullback, I would say, in the S&P 500. Nothing out of the ordinary, but a pullback nonetheless, back to the 50-day moving average. And so far as of Friday and Monday's close, we have managed to hold above the 50-day moving average on the S&P 500. So from that perspective, I would definitely say that is constructive here for the pullback to find some support and stability after Thursday and Friday of last week, finding a little bit of stability after that. What was a fairly violent sell-off that we saw here in the specific major cap indices, namely the S&P 500 and the NASDAQ 100. We did see the NASDAQ 100 pull back below the 50-day moving average, spending a couple of days now below the average. But overall, being below average is not necessarily a bad thing, just because from a probability perspective, being below the average simply means that there's a higher probability of a bounce higher from here. Now, when you look at the S&P and the NASDAQ 100, looking at the indices themselves, certainly this leads the potential for further downside. However, when you look at the Russell 2000, this is really where the picture changes substantially, because even though the S&P 500 and NASDAQ have pulled back to the 50-day and potentially below to and below the 50-day moving average, the Russell 2000 small cap indices remain firmly above the 50-day moving average, and nowhere near pulling back. So what you have actually seen over the past couple of weeks, or past 3 weeks specifically, is a pretty remarkable recovery. Basically, if you look at the Russell 2000 throughout the first half of 2024, the Russell 2000 lost in this particular time frame about 12% of relative performance to the S&P 500. Now, we had talked about the fact that the Russell 2000 lagging this far behind the S&P 500 is a big concern that we have with the health of the overall market rally, and that you need to see these stocks play catch up in order to have a better confidence in the equity markets as they effectively print new all-time highs without participation across the broader markets. And what we have seen over the past 3 weeks is effectively a complete reversal of 100% of the underperformance we've seen throughout the entire year has been largely been erased in the last 3 weeks. I'll be honest, that has greatly outpaced any expectations that I have of any catch-up trade in the past 3 weeks. But that's the reality, is that, as the S&P and NASDAQ sold off pretty heavily over the last 3 weeks, the Russell 2000 has not only not moved lower, it actually moved higher during that time. So the significant outperformance here has corrected a lot of the underperformance for this index that we've seen over the past year, over the past 6 or 7 months. Pretty incredible. And you see the same thing on the RSP, equal weight S&P 500 index, as you can see, trading near relative highs, near the all-time highs on the RSP, which also largely erases most of the underperformance we've seen throughout this entire year. It hasn't erased all of it, meaning there's still some lack of participation here in the equal weight S&P 500 index, but it certainly has made a lot of progress here in the last 3 weeks. And again, the question is, does that continue? Because if these markets continue to outperform, meaning the equal weight S&P 500 outperforms the market cap indices, that is actually a healthy rotation that we need to see in order to have more confidence in the markets as they reach all-time highs. So if this continues, that further provides a bullish backdrop for equities. Now, that in itself is not necessarily enough alone, so we have to look at other markets to see what other markets are telling us here as well. So if you look at growth versus value throughout the entire year, growth has outperformed value, and it really has accelerated here over the past, call it previous month or so. But in the last 3 weeks, almost all of that has been given up with regards to value coming back very strongly relative to growth. Whoops. You also have seen commodities break down below a pretty key support level here at 21.25. I do believe that these kind of breakdowns here do become buying opportunities. We've seen gold, dip a little bit, and that becomes, in my opinion, a buying opportunity for gold. You also have seen oil dip below $76. That also potentially is a buying opportunity. So as commodity starts to show further weakness here, that weakness, in my opinion, actually provides a opportunity for buyers to start stepping in for some of the commodities that we'll take a look at here in a few minutes. Now, one of the markets that have largely been unchanged through the volatility that we've seen over the past week or so is our bonds. Especially if you look at corporate bonds, you look at high yield corporate bonds, it has not sold off here with the rest of the market, meaning that kind of sell-off that we've seen in semiconductors hasn't rolled over to other markets. And that particularly is another area to pay attention to decide, is this the start of another leg lower for equities, or is this more of a correction that becomes a buying opportunity? And when you see bond markets not reacting to the sell-off, you lean more towards this is the dip that becomes a buying opportunity more so than there is further contagion and there's further downside coming. It doesn't mean that it can't happen. Bonds can certainly start, start seeing some losses, especially as we head into the Fed's interest rate tomorrow. If that surprises us in any way, shape, or form, we definitely could see bonds react, and maybe that could be the catalyst that does send things significantly lower from here. We'll have to see, but that's really kind of how we're largely viewing the broader markets and looking at the different asset classes, is that bonds haven't sold off. The rest of the market hasn't sold off. The sell-off is really largely contained to the one group of stocks that have formed an almost bubble-like formation with regards to semiconductors. And what we're effectively now seeing is a correction in those specific stocks. And out of that, a rotation back into value, into small cap, into the rest of the market that has not caught up with the market rally. And as a result of seeing that, we're actually having more confidence in the market rally here. So that is kind of where we currently stand when we look at the broader macro picture of the different asset classes and how we're interpreting the volatility we've seen here over the past few weeks. Looking at VIX, we are still trading around that 16.5 level here. We started last week at around 16. Now we're still closing around 16. So we are volatility, while spiking, has certainly started to slow down in terms of spikes. So that certainly gives fresh opportunity for volatility to start compressing a little bit and providing more of a buying opportunity here for equities as well. You have 10-year yields hovering just below 4.2% here. This largely is going to be driven off of the interest rate environment. The Fed interest rate decision this particular week, and any language around that July meeting, with hints as to what is likely going to happen in the next September meeting. Chairman Powell may not necessarily give what we're looking for, but the markets are currently pricing in a rate cut here by September. If anything in the language changes that expectation, that is what I believe could lead to some further volatility in bonds. But outside of that, I think the status quo is to expect the the bond markets to stay around that 4.2 level here on the 10-year. You see TLT largely staying flat here, trading sideways here over the past month or so, despite a little bit of volatility here. So this provides a potential buying opportunity for bonds to break out potentially above this 94.5 level here to the upside. You have the dollar index trading higher here to that 50-day moving average, which comes in around that 104.70, 105 resistance level that we've been talking about. This becomes now a potential selling opportunity. Anything at this 50-day moving average and potentially a little bit higher above that 50-day moving average potentially becomes a selling opportunity for dollars. So selling dollar yen is a particularly favorable trade at the moment, given the fact that the Japanese yen is looking at raising interest rates while the dollar is looking at lowering raising rates. So from a interest rate carry perspective, certainly favors looking at short currency positions such as dollar yen. Looking at gold, so we have seen gold make one crack above 2450. A couple of weeks ago, it failed to break out and continue forward here, but we're now knocking on 2450 one more time here, and this is really where I do think that gold. The setup here is quite bullish here for a potential continuation above 2450, what is effectively a double top breakout that failed a couple of weeks ago. The markets are making another attempt, and that is a fairly bullish setup here for gold to continue on to 2700 here to the upside. For those of you that are investors in gold or in gold specific miners or in terms of miners, this presents a potential opportunity to take a bullish exposure here in gold or gold-related companies. We have seen oil crack below $76, and I do believe that the breakdown here below 76 starts to become, a new buying opportunity for oil. Obviously, tensions in the Middle East are still quite high, and that is a potential catalyst for oil prices to spike as well. So this breakdown that we've seen here in oil over the past few weeks presents a buying opportunity for oil. Now, looking at the overall sectors, this is really where sector rotation is quite interesting because the vast majority of the underperformance we've seen here in the S&P 500 comes from technology, specifically semiconductors within the technology sector. So technology has seen a pretty significant decline here. And I guess the question for a lot of investors is whether or not there's further downside. Price action for technology does not look particularly strong. You have a strong underperformance, momentum is negative, price action doesn't look incredibly strong here. We have a big week of earnings for technology coming up. You have Meta coming up tomorrow. You have Apple and Amazon the day after. You have Microsoft today. So a lot of big earnings coming up. That is largely, in my opinion, what is going to drive the outlook for this specific sector. So far, technology as a sector, from a earnings perspective, hasn't been particularly stellar. Overall, this hasn't been a particularly stellar earnings season. Expectations going to this earnings season were high, and a lot of companies are effectively just meeting expectations, and that clearly has not been enough to push the markets to move continuously higher. And that is one of the factors to consider in terms of our outlook here for equities is the fact that the S&P 500 does trade at 21 times forward earnings. The NASDAQ 100 trades at 27 times forward earnings. So from a valuation perspective, there are some concerns as to the current price or value that these stocks are currently trading at and whether or not there's still room for further upside, and how much higher does corporate earnings have to come in order to see continuation of that multiple expansion, or do we are in an environment where we do start to see some contraction of multiples, and I think an environment where there are more stocks meeting expectations rather than beating expectations. That is certainly a recipe for potential multiple contraction here, because the S&P 500 is well above its median forward earnings multiple, which is around 16, 17, we're trading at 21 times forward earnings. We're already a pretty significant margin above our long-term median. And same thing on the NASDAQ 100. So that is, the other factor to consider as to whether or not markets can continue moving higher is, are corporate earnings strong enough to justify these current valuations and justify valuations to further expand from here. So far, from what we've seen in terms of this earnings season, not particularly strong on that front. Things could change this week, with the major tech names reporting. But that is largely, in my opinion, what is going to be driving some outlook here for equities. Um, Consumer discretionary, was leading the markets lower here, had a pretty nice bounce here over the last couple of days off of that 50-day moving average. There is a pretty big gap that has remains to be filled. So, rallies into that gap are potential shorting opportunities here for consumer discretionary, which as a sector has largely underperformed the S&P 500 this year. Communications largely starting to see a little bit of underperformance here as well. As you can see, now trading below the 50-day moving average. That 50-day moving average could potentially start coming in and start acting as resistance. On the flip side, all of that flow out of discretionary, out of technology, out of communication has been flowing into sectors like financials. We've seen a very significant outperformance of financials here over the past 3 weeks relative to the S&P 500. Certainly one of the sectors that are outperforming. Consumer staples as well, breaking out above $78 and holding those levels. So one of the few sectors trading near all-time highs. Same thing for healthcare, breaking out above this 148 so far, holding on to that, which means that we're seeing a fair amount of outperformance relative to the S&P 500. Materials outperforming the S&P 500, trading back near all-time highs. Industrials breaking back above 126 and holding that level of support, significant outperformance to the S&P 500. And real estate, the big gain here this week is real estate, a big outperformance here in just the last few weeks on the back of kind of expectations of lowering interest rates. It seems like real estate as a sector has firmly turned a corner here, breaking out above that $40 resistance level double top, holding those level as support, providing the potential base for real estate to outperform from where we currently stand right now. Energy pulling back a little bit, but so far holding that 50-day moving average. This is a potential buying opportunity for energy-related companies, and then largely utilities as well. We've continued to see utilities grind higher from here back towards those all-time highs at $72 here as well, and starting to also, again, outperform a little bit here over the past couple of weeks relative to the S&P 500. And then if you look at kind of some subsectors, home builders, strong outperformance here relative to the S&P 500. That breakout here above 112 is a pretty significant reversal, considering just a couple of weeks ago, we were talking about the fact that home builders were breaking below this major support level, significant outperformance, momentum was negative. We were looking for potentially much lower rates. And now what we have seen is a significant reversal in the other direction. So we were in this trading range. We thought we were seeing what looked like it was going to be a breakdown of the range, but instead what we're starting to see is a breakout from the top of the range. So pretty significant reversal here from home builders. The question is whether that can continue. Home builders have seen a lot of optimism here in the last 3 weeks. Is that optimism justified, on the back of expectations for rate cuts, or is this starting to get a little bit ahead of ourselves? So we'll continue to monitor that here this week and see where we currently stand. And then lastly, semiconductors. The big underperformance here is from semiconductors. This is the risk that I do see where there could be some further downside, some further volatility from these semiconductor stocks that trade, at a relatively elevated valuation as a industry. And this week's tech earnings could potentially be further catalyst for these stocks to see a little bit more of that multiple contraction before they get to valuations that look more compelling. Right now, those valuations on semiconductor stocks are still quite high, still pricing in a lot of perfection to some degree. And the question is whether or not earnings are catching up with what has been priced into the markets. And it's not particularly clear that that correction is at the bottom just yet on semiconductors. So taking a look at this particular week and some opportunities that we see. First one I want to take a look at here is Alphabet. So Alphabet last week reported earnings, and the stock reacted negatively to earnings. As you can see, we had, it was trading around 183, 182 before the earnings, and then it traded all the way down to this 165 level. But markets have reacted fairly positively to that 165 support level from a price action perspective. And I do believe that this potentially is a buying opportunity here for Alphabet. For those of you that are interested in getting into some of these tech names for the long term as an investment. Now, Alphabet out of the Magnificent Seven is one of the few that are trading at valuations that, in my opinion, are very reasonable. It trades at about 21 times forward earnings, which is in line with the S&P 500, while at the same time it's expecting to grow revenues and EPS, well into the double digits, so well ahead of the average S&P 500 in terms of expected growth. Much stronger margins than the average S&P 500, than the S&P 500, much stronger margins than even the Nasdaq 100. So the fact that it trades at a valuation very similar to the rest of the S&P 500 tells me that this stock is marginally undervalued, given the future expected growth and the outlook of this particular stock, especially with regards to cloud computing and AI. It really sold off on the back of what was a few $100 million miss on YouTube revenue, which I think in the grand scheme of things is a pretty small miss for Alphabet. And I think that markets overreacted a little bit to the downside, and I think that becomes a buying opportunity for investors who are looking to get into some these kind of technology-related stocks in the long run. Alphabet certainly would be one of my top picks given the current valuation that it's trading at. Another one I want to take a look at here is Comcast. Now, a few weeks ago, we brought up Charter Communications when it was just breaking out around 300. It's a very similar trade setup from a charting perspective and a valuation perspective. Both Charter Communications and Comcast for multiple years have been underperforming here. But what we have started to see here over the past 3 months here or so is kind of a bottom form between the 39.40 and 37 or so. So we've had this kind of underperformance that was been followed by this period of kind of bottoming and some signs that that bottoming is starting to break out, especially when you look at the relative performance to the S&P 500. You want to see a bottoming formation breakout here to the upside on an absolute basis, but you also want to see that breakout on a relative basis. So we're seeing both, and that is why this chart setup looks very similar to Charter Communications. If you look at Charter Communications, we brought it up when it was just breaking out above 300. It's now trading at 367. Comcast just broke out from 40. I think this has room to run into that 42 and a half, 44 level here to the upside. So Comcast trading at 9.5 times forward earnings, it's not expected to grow particularly fast, especially it pretty much is expected to grow in line with the sector. EPS of about 6-7%, revenues of about 1-2%. So nothing to write home about with regards to expected growth. Margins are slightly better than industry average. Yet it only trades about 9.5 times forward earnings. Compare that to the industry, telecommunications services, which trades at an average multiple of around 11.5, forward earnings. So the fact that it trades at 9.5 means that it trades at a pretty substantial discount relative to the industry. And I think that is where, you have a technical setup of what looks like a bearish to bullish trend reversal and a valuation that looks somewhat compelling given the expected growth rates here for Comcast. So that's one opportunity to take a look at. And then the last one I'll leave you with here is Costco. We've been talking about Costco for a few weeks now, especially since, it made that crack at above 900. And we noted that that crack higher towards 900 was coupled with divergence, that was our first sign that there is exhaustion here for buyers and that things were going to start reversing lower. A couple of weeks, last week we brought up Costco again. The fact after it had already dropped from close to 900 down to 840, and we had talked about this 840 as a support level and whether or not that support level was going to hold. But at the beginning of last week, that we started to see that breakdown below that support level, and we noted last week that not only were we breaking down from an absolute basis perspective, but from a relative basis, we had already broken down. Now we've retested these levels as a resistance and starting to roll over here further, and momentum, as you can see, has also turned negative here. So when you look at Costco breaking down below 840, this is really where I think that there's some further downside here for Costco. And the valuation here certainly backs up that story. Costco's still trading at about 45 times forward earnings, which is a very, very significant margin higher than the average S&P 500. We're talking 150% higher than the average S&P 500 stock that Costco's trading at. Yet, we're expecting growth to be very much in line with the average S&P 500 stock. We're talking about 11% EPS growth, 67% revenue growth. So marginally higher than the average S&P 500 stock, yet it trades at a valuation that's 150% higher. And further to that, net margins on Costco is less than 3%. So for every $1 they generate in revenue, they only generate about less than 3 cents in net profits. We're talking about very thin margins, and thin margin stocks don't trade at high valuations unless they have very, very strong growth. And that's just not what Costco is in terms of strong growth. We're talking 20, 30% EPS growth year over year. We're not seeing that from Costco. So the fact that this stock ran from $500 to $900 in a very short amount of time really speaks to the fact that the stock has outperformed its actual growth. Corporate earnings are not growing as fast as the stock price is indicating, and that is a risk that we see some further downside here for Costco. So those are the three opportunities that I want to highlight for this particular week. Overall, if you look at the markets, like I said, fairly constructive on the volatility that we've seen. The markets can't just move higher and go uncorrected. They need to see correction. And the fact that we've seen correction in the parts of the market that has seen some excess overall is positive for the markets. Can that excess spill further over into the next week or so? Absolutely. And there is some potential further volatility given this is a big week for earnings coming up. But overall, the markets are fairly constructive here for equities. The rotation is relatively constructive, out of tech into the rest of the sectors. But there are still opportunities on both sides right now on the bullish and bearish side. So with that, hopefully that gives you a good sense for where we currently stand from the bigger picture perspective and some opportunities that we see here in this broader markets. So I hope that you find this useful. And I will see you guys here next week on our next Tuesday morning market outlook session. Thank you so much and have a great trading day.